Welcome to the debate on breaking news to trading moves. So imagine going to your job and failing at your primary task 29 out of 31 times. And then at the end of the year, you're not just still employed, you are a multimillionaire.
Yeah, if you're listening to this and thinking that sounds completely illogical, you're definitely not alone. It just defies our basic programming, right? We're taught that success requires being right most of the time.
Exactly. But today we are evaluating this counterintuitive reality in the financial markets. The tension between asymmetric payoffs, which is convexity, and predictive probability. The core question we are looking at is whether traders should prioritize structural convexity, meaning, outsized rewards at the expense of a terrible win rate.
Or, on the flip side, whether they should prioritize predictive accuracy to secure a much higher baseline probability of success. And I'll be defending that second perspective today. Because ultra-low win rate systems, they create insurmountable mathematical and, frankly, psychological drawdowns.
Right.
I maintain that utilizing higher probability predictive models, systems that establish a really solid baseline of accuracy, is a superior approach. It's viable for preserving capital and maintaining the mental equilibrium you actually need to execute a strategy long-term.
And I will argue that trading success is strictly defined by convexity and expectancy. A high win rate is, it's mostly an ego-driven metric. It comforts the trader, sure, but it limits their actual wealth generation. Let me illustrate the mechanics of extreme asymmetry by looking at the documented strategy of Takashi Mori.
The Japanese trader known as CIS?
Right, CIS. He accepts an extraordinarily low win rate. I mean, he reportedly tolerates losing 29 out of 31 trades.
Wow, 29.
29. And he achieves this through a rigid risk management protocol that just brutally cuts any position the second it moves against him. He does not hold through minor pullbacks hoping the price recovers. He takes the loss immediately.
Which, let's be honest, guarantees he spends the vast majority of his time just bleeding capital through constant, repetitive losses.
Exactly. But you have to look at what happens on those two winning trades. When the price actually moves in his favor, he relentlessly pyramids into the position, adding more and more size. So the geometric growth of those two massive winners vastly eclipse the 29 tiny fractional losses.
Right, but
this completely aligns with the trend-following methodology chronicled by Michael Kuffel and the philosophy of macro ops. Capturing market outliers requires accepting frequent minor losses as the basic cost of doing business. You are paying small premiums to find the rare, unbounded trend.
I see the mathematical purity of that on a spreadsheet, I do. But human beings don't live in spreadsheets.
Well,
Ultra-low win rates are mathematically perilous and practically unviable for human execution. Relying on 2 home runs to salvage 29 strikeouts requires a level of absolute, robotic perfection that human psychology simply does not permit. Instead of embracing constant failure, we really should utilize predictive models that establish a higher baseline probability.
okay, give me an example of what you mean by that.
Sure. Consider the RSIS international study detailing an Ethereum trading bot. This is not just a basic algorithm. It utilizes logistic regression fed by multiple technical indicators, like the relative strength index and the commodity channel index, to calculate exact market probabilities in real time.
Wait, you're talking about traditional bounded oscillators. Those are notoriously lagging indicators. They tell you what just happened, not what is about to happen.
They lag if you use them in isolation, yeah, but that is not the mechanism here. The Ethereum model constantly updates its prediction coefficients. It mathematically ensures that the predictive probability of a directional move remains strictly above a 0.5 threshold before it authorizes a long or short position.
Uh-huh.
By demanding that higher baseline probability of success, this approach actively minimizes devastating drawdowns. It preserves capital through highly accurate surgical trades rather than, hoping a rare black swan event arrives to bail out a constantly bleeding portfolio.
Let's address that concept of a bleeding portfolio, because the math of expected value, EV, is completely detached from the human desire to feel correct. A strategy is only viable if the math works over a large sample size. If a trader utilizes strict parameters, specifically the macro ops rule of risking no more than 1% of their total capital per trade.
Which is a good rule, but
Right.
But if they follow it, those 29 losses are not a crisis. They are merely small, calculated business expenses. Research from GoTrade explicitly clarifies this mechanism. Convex strategies actively benefit from large, unexpected market moves. The more chaotic the market becomes, the better the strategy performs.
I think we need to be very precise about what convexity actually means in a live market environment, because it is frequently conflated with simply taking on massive risk.
Oh, that is a crucial distinction. People often confuse convexity with leverage.
Exactly.
Leverage is borrowing money to drive faster. If you crash, the damage is multiplied. Leverage amplifies both gains and losses in a straight line. Convexity is entirely different. Convexity changes the shape of your returns.
Right.
Think of it like paying a small toll to drive on a specialized road. If you find gold on that road, you get to keep all of it. And there is no limit to how much you can carry. But if you find nothing, you only lose a $2 toll. Your downside is hard capped by your stop loss, but your upside scales infinitely as the trend continues. You're paying a tiny premium to hold a position that could yield a massive multiple.
That toll road analogy sounds perfectly reasonable until you realize you have to drive down 29 empty roads in a row.
Well, if you have the discipline.
But that's the thing. The mathematics of expected value make perfect sense in theory, but human psychology shatters this math in practice. Day trading is already a mentally exhausting endeavor. Now imagine the cognitive dissonance of having real-world responsibilities, having bills to pay, and not making a single profitable trade for an entire month. Most retail traders simply cannot endure the psychological drawdown of Morris's extreme strategy.
But if the risk management restricts the financial damage to just a fraction of a percent per trade, the trader's account is completely safe.
The account might be surviving, but the trader's mind is breaking. When a human being experiences 9 consecutive losses, the psychological pressure to snatch the first glimmer of profit on the 10th trade becomes overwhelming.
Yeah, they get anxious. Right. They will cut their winners short just to feel the relief of a green trade on their screen. They sabotage the very geometric growth the entire system relies on. Furthermore, there is a vicious mathematical trap hidden in low win rate systems. Which is? If you miss just one of those rare required home run trades, maybe you slept in, maybe your internet dropped, maybe you hesitated out of fear, you suddenly need to hit double the home runs in your next sequence just to break even. It forces the trader to double down on risk to repair the damage of a single missed execution. I see why you think that, but let me give you a different perspective. You are identifying a flaw in human emotional control, not a flaw in the actual strategy. If the human cannot handle the psychological burden of waiting for convexity, perhaps the solution is to fully automate the rigid rules of the trend-following system rather than abandon the asymmetric advantage entirely.
Automate the trend following?
Yes. The market historically rewards those who can endure discomfort. Trying to predict the market just to soothe our biological need for certainty is exactly what leads to long-term failure. The desire to be right 55% of the time often blinds traders to the fact that their winning trades are too small to offset their inevitable large losses.
I don't view statistical modeling as soothing a psychological need at all. I view it as a structurally superior way to engage the market. Relying solely on reactive trend breakouts, just blindly entering trades to see if a trend forms, it's incredibly inefficient when modern data structures can filter out bad setups before you ever risk a single dollar. I mean, why pay the toll 29 times when data can tell you 28 of those roads are dead ends?
Because data cannot predict the future. The macro ops framework is incredibly clear on this point. Classical financial metrics, earnings reports, predictive algorithms, they are typically useless for gaining an edge because the market has already discounted that information into the current price.
But
By the time your model identifies a high probability setup, high-frequency algorithms have already priced it in. Price action is the only absolute truth.
I am not talking about analyzing quarterly earnings reports, though. Let's look closely at the actual mechanics of the RSS Ethereum model. It does not look at static price points. It uses a 50-period z-score to standardize and normalize the data.
Okay.
Crypto is incredibly volatile. A 5% move in Ethereum might mean nothing, whereas a 5% move in an index fund is massive. The z-score standardizes this volatility, so the model knows if the momentum is actually anomalous. It then feeds 35-period RSI and DMI parameters into a cross-entropy loss function.
For the listeners who might not be data scientists, break down how our cross-entropy loss function actually operates in a live moving market.
Sure. Think of the cross-entropy loss function as a ruthless, real-time performance reviewer. It quantifies the exact divergence between the model's predicted probability and the actual real-world market outcome.
If the bot predicts a 90% chance that Ethereum will rise and the price drops, the cross-entropy function penalizes the model heavily for being so confidently wrong. It uses that error margin to immediately adjust the weights of the RSI and CCI indicators. The model adapts to changing market dynamics on the fly. It is predicting directional strength based on quantified momentum, rather than guessing 20 times just to see if one trade catches a prevailing breeze.
I grasp the mechanism, but the core premise is still flawed. Technical analysis should never be treated as a crystal ball. It is purely a signaling mechanism. Breakouts out of consolidation patterns are alerts that real capital is flowing in a new direction. Predictive models are notoriously prone to curve fitting.
I'm sorry, but I just don't buy that. How are you defining curve fitting in this context?
Model on historical data, you are essentially giving it the answers to yesterday's test. You optimize the parameters to look brilliant on past data, creating this beautiful illusion of a high win rate. But markets are not static. They undergo regime changes.
Sure, from low volatility to high volatility.
Exactly. We move from bull markets to bear markets. When that regime changes, those hyper-optimized predictive parameters fail catastrophically because they are predicting a market environment that no longer exists. The trend follower does not predict. The trend follower simply reacts to where the money is actually moving right now.
Let me tell you why that argument doesn't hold up here. That assumes the model is static, which contradicts the entire purpose of the dynamic updating I just described. The Ethereum model proved its robustness by generating consistent net profit specifically through its short entries during varying market conditions.
Short entries.
Yes, it executed short trades precisely when the predicted probability of an upward movement fell below the 0.5 threshold. It didn't need to wait for a long-term trend line to break, which often means giving up the first 20% of the move just waiting for confirmation. By utilizing dynamic indicator synthesis, it anticipated the exact moment buyers were exhausted and capitalized on the downward movement immediately. It proves that advanced systems can maintain a high win rate without falling victim to curve fitting.
Okay, but even if we accept that a sophisticated model can temporarily achieve a high win rate and adapt to regimes, it completely ignores the ultimate determinant of success in trading, which is position sizing. Position sizing is the bridge that makes low win rates not just survivable, but astronomically profitable. Let's return to the mechanics of Mori's strategy, specifically a technique called rectangular buying.
Ah, the block scaling method.
Yes. Think of it like a general sending scouts into unknown territory before committing the main army. If the trader ultimately wants to hold 1,000 shares, they never buy them all at once. They send out a scout, a small block of 200 shares. If the price immediately drops, the scout is killed, but the trader only loses a tiny fraction of 1% on a 200-share position. The financial impact is negligible.
Right.
But if the price rises, meaning the scout found clear terrain, the trader buys another 200 shares. They are mechanically enforcing the age-old ethos: cut losers short, let winners run.
But they are constantly paying execution costs for every single one of those dead scouts.
The costs are minimal compared to the protection it offers. They are not predicting the terrain. They are letting the market prove its strength before committing more capital. This creates an optimal, dynamic risk-reward scenario. The trader is fully sized at 1,000 shares only when the market is definitively trending in their direction. You only need a fractional win rate to achieve massive returns when your position size mechanically expands exclusively during winning trades and shrinks during losing trades.
Look, sizing is undeniably vital. No credible professional would dispute the necessity of strict position sizing. However, prioritizing convexity without a baseline accuracy increases your operational costs to an unsustainable degree. It is what we call death by 1,000 cuts.
Well,
It's not just about the fractional loss on the trade itself. You have to factor in slippage, commission fees, and the opportunity cost of tied-up capital.
but the massive, outsized winner pays for all of that slippage and commission 100 times over.
That relies on the dangerous assumption that the outsized winner is guaranteed to arrive before your capital reserves or your sanity runs out completely. Look at the specific metrics established by Trade Ideas. They advocate aiming for at least a 1-to-2 risk-reward ratio.
Right.
In practical terms, on a chart, that means risking $100 to potentially make $200. This offers a very healthy degree of asymmetry without demanding perfection. But they argue forcefully that this must be paired with a reasonable baseline expectancy. Relying on a system that resembles flipping a coin, or worse, a system that loses 90% of the time, while hoping a singular massive trend will bail out the math, is a fast track to margin calls.
I mean, a 1-to-2 ratio is incredibly conservative. It severely limits wealth accumulation. A true structural trend-following model might hit a 1-to-10 or even a 1-to-20 ratio on a strong, multi-month move. Why cap your upside at $2 when the market is willing to hand you 20?
Because you have to ask how often those 1-to-20 moves actually happen. They are rare statistical anomalies. Building an entire daily operational infrastructure around capturing a yearly anomaly while bleeding capital every single day waiting for it is terribly inefficient. Trade Ideas emphasizes tracking trade expectancy diligently, focusing on the expected value per trade over a monthly or quarterly basis.
Yeah, EV is critical.
Exactly. So if you pair strict position sizing with a mathematically sound predictive win rate, say 55 or 60%, you achieve something crucial. You preserve your financial capital, you preserve your mental equilibrium, and you still generate compounding returns without requiring a black swan event to validate your entire year. You don't need a 10-bagger to grow an account if you are consistently hitting reliable probabilistic targets.
Well, we have detailed two intensely different structural frameworks today. For my part, I maintain that letting winners run and ruthlessly cutting losers at a fractional percentage remains the undeniable path to outsized trading wealth. Expectancy must always take precedence over the ego's desire to be right. By embracing convexity and utilizing mechanics like rectangular buying, traders can mechanically restrict their downside while leaving their upside entirely unbounded, allowing them to capture the market's most lucrative extended trends.
Yet I maintain that any system, no matter how mathematically elegant on paper, must align with the realities of human execution and capital constraints. Utilizing modern regression models, standardizing volatile data with tools like z-scores, and enforcing probability thresholds to maintain a higher, consistent win rate is a vastly superior method. It avoids the catastrophic psychological drawdowns of trend following and provides a stable, repeatable framework for compounding capital without relying on market anomalies.
Yet, despite our opposing frameworks on probability versus asymmetry, it is clear we share one area of absolute agreement. Regardless of whether you are running a logistic regression bot that updates in real time or manually pyramiding into reactive price breakouts, rigid risk management is paramount.
Absolutely.
The fundamental rule of risking no more than 1% of total capital per trade is the foundation that keeps any trader in the game.
That is the one hard constraint you cannot violate. Without that strict cap on risk, both the high probability predictive model and the low probability convex model will eventually trend towards zero. A single catastrophic loss can wipe out a year of high probability compounding just as easily as it can destroy an account waiting for a convex trend.
It suggests that listeners have much more to explore regarding how they assess their own psychological tolerances and the mathematical expectancy of their specific systems. Before you decide whether to embrace the discomfort of low win rates or the complex modeling of high probabilities, you must evaluate what your own mind can actually endure during a drawdown.
Yeah, it's a vital requirement for anyone looking to engage the market sustainably.
Thank you for joining us on The Debate, on breaking news to trading moves. Until next time.